Let's move to question number 3 now. The question says JP Limited's financial year ends on 30th September 2020. So this means that the year start would be 1st October 2019. And the following balances were available at that date. At what date? At year end 30th September 2020. So first of all, we have debentures which are repayable in 2026, right? So this is a company accounts question, therefore we have debentures. Then we have admin expenses, carriage inwards. Carriage inwards is the transportation cost which is incurred while bringing the goods into your premises. Then we have the distribution cost, debenture interest paid. So 700 is the interest which is paid during the year. Inventory at 1st of October 2019. This is what? This is the opening inventory, right? Inventory at the start of the year. Then we have non-current assets at book value at 1st October 2019. So again we have the opening net book value of the non-current assets. This means that you have to calculate depreciation for the current year. Then we have provision for doubtful debts. Again the balance brought down is given to you. You might have to calculate the current year provision for doubtful debts. Then we have purchases and revenue, and lastly trade receivables. Then we have additional information. Let's quickly review what do we have in additional information. First of all, we have the inventory at 30th September 2020, which is the closing inventory, of course. Then we have interest on the 7% debentures had been paid up to 31st of March. Okay, so we have to find out how much is accrued and what amount will go in the income statement for debentures. Then we have information related to admin expenses, and number 4 we have distribution cost. Non-current assets should be depreciated, so depreciation related adjustment. Then we have irrecoverable debts 500, which is to be written off. So these are not yet written off as bad debts. We have to write them off, and then we will be required to calculate our provision for doubtful debts, which is maintained at 2% of the trade receivables, right? Now let's move towards the requirements. Part A says calculate the cost of sales for the year ended 30th September 2020. Easy start. Cost of sales, what is the formula to calculate cost of sales? The full formula to calculate cost of sales is like this. You take the opening inventory, we add the purchases to the opening inventory, and if there are any purchases returned, so these are first subtracted, and then if there are any goods withdrawn by the owner, right? So goods withdrawn during the year by the owner are also subtracted from the purchases, and carriage inwards is added. Carriage inwards is the transportation cost which is incurred while bringing the goods into your premises. So this is a directly attributable cost to the inventory. That is why it is taken over here and not in the other expenses. In the second section of income statement, carriage inwards are added over here. And lastly, we subtract the closing inventory, right? So opening inventory plus purchases less purchases returns and the goods withdrawn by the owner, add carriage inwards and less closing inventory, and then you will have your cost of sales, right? So in this question, how many components do we have for cost of sales? We have opening inventory amounting to 66,000, right? So opening inventory will be added. Then we have purchases. Purchases are how much? These are 263,000. There are no purchases returns in this question, and there are no goods withdrawn by the owner as well. However, we have carriage inwards amounting to 1,500. And lastly, we have closing inventory as well, which will be subtracted. So less closing inventory, and this is given in adjustments. This is $59,000. So less $59,000, right? So the cost of sales will be $271,500 is the cost of sales for the current year, right? Easy 2 marks. Let's move to part B now. Part B says calculate the increase or decrease in the provision for doubtful debts at 30th September 2020. So we have to find out whether the provision for doubtful debts is increasing as compared to last year or whether it is decreasing. So how do we do that? First of all, we take the trade receivables, and the figure which is to be taken for trade receivables should be the one which is after the subtraction of bad debts by the year end. So the trade receivables figure which is given to us in the list of balances is $80,500. So 80,500. Now should I apply the 2% provision for doubtful debts on this figure? No, I cannot do that, because you remember in adjustment number 6 we found out that irrecoverable debts of 500 are to be written off, which means that these 500 bad debts are still part of the trade receivables 80,500 balance, right? So first of all, I have to subtract this bad debts because I won't be recovering this amount from my customers, and then apply the provision for doubtful debts percentage of 2%. So first of all, I will subtract or less my bad debts given to me in my adjustments, and these are 500. So now the final trade receivables which I am expecting, from whom I will be recovering my money, this is 80,000, and on this value I will now apply provision for doubtful debts. So the percentage of provision for doubtful debts is 2%. Out of these 80,000, I am estimating that I might not receive 2%, right? So 2% of 80,000 is how much? It is $1,600. This is the estimation, right, made by the business, that from 80,000, 16,000 might not be received. Now, the question was not just to calculate the current year provision for doubtful debts, the requirement was to calculate whether it is increasing or decreasing. So, in the list of balances, the provision for doubtful debts balance brought down was given to us. This was the brought down last year provision, and that was $1,000, right? It was $1,000, and in the current year end, we have found out that how much are we estimating now? $1,600, right? So, this means that from $1,000 it has been increased to $1,600. This means that there is an increase of how much? Increase of $600 in my provision for doubtful debts as compared to last year. If, for instance, the figure given to us in the list of balances for provision for doubtful debts balance brought down, suppose it was $2,000, right? Suppose it was $2,000, and now I am estimating that I might not receive $1,600. In this case, there would have been a decrease of $400. That last year I estimated more, and now I am estimating less, right? But in this case, there is an increase by $600. Okay. Now let's move to part C. Part C says, prepare the income statement for the year ended 30th September 2020. The format is given to us. We know that how do we start income statement? We start the income statement with, of course, the revenue, and if there are any sales returns or revenue returns, so we subtract that as well. But in this question, we don't have that. So revenue is $529,500, right? So this will be taken as it is, $529,500 in the last column. Then we subtract the cost of sales, right? So you remember in part A, we have already calculated cost of sales, so you don't have to do the calculation again. You just take that same figure, and that was $271,500. So less $271,500 from the revenue, and then we'll have our which figure? The gross profit, and that is $258,000. This is the gross profit. Then after gross profit, if there are any additional incomes, so we first add that to the gross profit. But in this question, there are no additional incomes, right? So for instance, there is no rent received, interest received, or decrease in provision for doubtful debts. No, they are only expenses. So then after gross profit, we will write less other expenses, right? Now in this question, we have a very long list of expenses. First of all, we have admin expenses. Carriage inwards has already been taken in cost of sales. Then we have distribution cost, debenture interest is also there. So this, and we have the depreciation on non-current assets, provision for doubtful debts, the increase of course, and we have bad debts as well in this question, right? So let's first write down the list of expenses that we have. Okay, so starting with admin expenses, the figure given to us in the list of balances is $44,000, right? But there's an adjustment related to admin expenses, and in adjustment number 3, it says admin expenses include rates of $1,200 for the 6 months ending 31st of March 2021. We know that the year end is 30th September 2020, so all the incomes and all the expenses up till this month, right, 30th September 2020 will be taken in income statement, and any expenses beyond this month, for instance for October and onwards, October 2020 and onwards, will not become part of our income statement, right? Now in adjustment number 3, it says that rates of $1,200 for the 6 months ending 31st March 2021 have already been paid. 6 months ending 31st March means from March 6 months back, right? So that would be October 2020 till March 2021. October, November, December, January, March, 6 months. These 6 months rates have already been paid, and which is the amount is $1,200, and this means that this $1,200 are already there in the 44,000 admin expenses given to us in the list of balances. But do you think that these 1,200 should belong to the expenses of the current year? No, because this is a prepaid expense, right? These expenses have already been paid, but they belong to next year starting from October 2020. Our year end is 30th September 2020. So, all of this 1,200 should not become part of this 44,000. That is why it should be subtracted from this. It is a prepaid expenditure, it belongs to next accounting period. So, the admin expenses would be 44,000 less $1,200, and that would be 42,800. Right. Now, let us move to distribution cost. We are done with the admin expenses, right. Then distribution cost. Is there any adjustment related to distribution cost? Yes, there is, and it says that distribution cost of $800 were outstanding at 30th September 2020. This is what? This is an accrued expense. $800 should have been paid by the year end, but they have not been paid. But now, since they belong to current year, that is why this 800 should be added to the 38,000 figure given to us for distribution cost, which is already paid. So, 800 should also be added in this figure. So, this means that our distribution cost, which will go in the income statement, will not be just 38,000, but 38,000 plus 800, and that would be 38,800. Next, we have provision for depreciation, right. You remember there were non-current assets given to us at net book value, the opening ones, and in adjustment number 5 it says non-current assets should be depreciated by 10% using the reducing balance method. So, reducing balance method, we know that we charge depreciation on the net book value if we are using this method, and the non-current assets figure given to us in the list of balances is already at net book value, right. So, this means that you will directly apply the percentage rate on this one, that is 610,000 multiplied by 10%, and that would be $61,000 of depreciation for the current year ended 30th September 2020. So far all the adjustments are really easy, right. $61,000 is your depreciation. Then the next expenditure that we have is provision for doubtful debts. For that we did the calculation in part B. We calculated that $1,600 is the current year provision for doubtful debts, and there was an increase of $600. Now, what do you think should I take? Which figure should I take in my income statement? The full 1,600 or just the increase? Just the increase will go in my income statement, right? Because in the current year, I am estimating that I might not receive how much, by how much? 600 more as compared to last year. So, the figure which you get after applying the percentage rate on the trade receivables is the balance CD figure, which is subtracted from your trade receivables in the statement of financial position. However, just the increase or the decrease goes in your income statement. In this case, there is an increase, so this is what? It is an expense. If it would have been a decrease in provision for doubtful debts, then it would become an income for you. So, just the increase of $600 will go in your provision for doubtful debts, and do not forget that there is another expense as well, which is bad debts, right. Irrecoverable debts of 500 are to be written off. So, these have not been written off yet, you have to write them off, and this means that there is an additional expense of $500. So, let us quickly check once again that how many expenses have been taken. We have taken the depreciation. Yes, we have taken the doubtful debts as well, the bad debts as well, and purchases, revenue, these also have been taken, and opening inventory as well. Last thing that is left is the debenture interest, right, for which we have an additional adjustment of point number 2. But first we will subtract all other expenses from the gross profit, so that we have our profit from operations, and then from that figure you will be subtracting your debenture interest, so that you arrive at profit for the year. So, the total expenses are 143,700. These will be subtracted from the gross profit, so that we have profit from operations amounting to $114,300, right. Now, let us calculate the debenture interest. The debenture interest amount given to us in the list of balances is how much? It is $700, and this is the debenture interest paid. But please be sure that we don't take the expenses which are paid during the year. No, we take those expenses or the interest amount which is incurred in the current year, right? Incurred and paid are two different things. Incurred means the total expense which should have been paid, which belongs to the current year, and paid is something else. Paid is sometimes accrued, paid is sometimes prepaid as well. That is why we do the adjustment, because we follow the accruals and matching principle. So therefore the debenture interest which is paid is $700, right? But you have to check that whether this is the full amount that is incurred in the current year as well or not. So 7% is the rate which should be applied on the amount of debentures, and that would be 7% multiplied by 20,000. $1,400 is the total expense, interest expense, which should have been paid by the year end. But how much is paid? Only 700 is paid. This means that the remaining is accrued, and that is also what the adjustment number 2 says, that interest on the 7% debentures had been paid up to 31st of March 2020. So this means that how much is accrued from April till September 2020. April, May, June, July, August, September, 6 months interest has been accrued. That is why only half is paid and half is yet to be paid. But please don't make this mistake that you take 700 in your income statement. No, because the full expense will be taken in the income statement. So 1400 will now be subtracted from your profit from operations, and then you will arrive at your profit for the year, which will be $112,900. This is the profit for the year after all the expenses have been subtracted, right? So then you will have your 12 marks. Very good. Now let's move to part D. Part D says complete the table by placing a tick in the correct column to indicate the effect on the equity of JP Limited of each of the following. Now before solving this part, you should be very clear that what equity is actually made up of for companies. So equity consists of your ordinary share capital plus your preference share capital plus the general reserves and your retained earnings. Debentures is not part of your equity. Debentures is a long-term liability. It is the money generated or the money raised from an outside source. It has to be repaid, right? So these are the components of equity: ordinary share capital, preference share capital, general reserves and retained earnings. And what is the requirement? The requirement is that whether these transactions, how will they affect your equity, right? Whether they increase it, whether they will decrease it, or whether there will be no effect. Now before reading these transactions, let's just quickly review the statement of changes in equity format. The statement of changes in equity is made up of these, of course, these components of equity, these four, and there is a total column. First of all, we take the opening balances, then if there is any share issue during the year, so that is also added in the ordinary share capital or the preference share capital. So it increases your ordinary share capital basically. Then if there is a profit or there is a loss, that is adjusted in your retained earnings column. Profit increases retained earnings and loss decreases it. Then if there are any transfers to general reserves, so these are transferred from the retained earnings. So you subtract that amount from retained earnings and you add the same amount in your general reserve. That is why there is no effect on the equity. You increase one item of equity and you decrease the other component, so there is net no effect. And lastly, if any dividends are being paid, so they are also being paid from the retained earnings, so they decrease your retained earnings, and then you will have your final balances. Now let's read the transactions. The first one, which is already solved, it says issuing additional debentures. So debentures, we know that this is a non-current liability. It will not affect your equity, right? So there is therefore no effect. Then the second one says issue additional ordinary shares. So ordinary shares is what? Ordinary share capital. This will increase this item of your equity. So therefore, issuance of additional ordinary shares will increase your equity, right? As we saw in the format as well, if there is any share issue, it will increase your capital. Then third one says payment of ordinary share dividend. You are paying dividends, so dividends are being paid from your retained earnings, so therefore they will decrease your retained earnings. So that's why the effect on equity will be a decrease in retained earnings if dividends are paid. Then proposal of ordinary share dividends. You have just proposed that you might give this much of the dividend to your ordinary shareholders. So just the proposal, just an agreement not yet given, will have no effect on your equity. If once they are paid, then they decrease your equity or your retained earnings, but just a proposal will have no effect in your on your equity. These are just written in the notes to accounts, right? These are not yet subtracted, not yet paid to the shareholders. Then lastly, it says transfers from retained earnings to general reserves. So general reserves balance will increase and your retained earnings balance will decrease because you are paid from retained earnings. Therefore, will it increase or decrease your equity? There will be no effect on your equity, right? One component of your equity will increase, another one will decrease, so net effect will be 0. So this was for 4 marks, and we are done with the third question as well. So overall it was a good and easy question, and there was no theory in this question as well, right? The first 3 parts we calculated cost of sales, provision for doubtful debts, and the income statement we prepared, and lastly we were just required to tell that whether there will be an increase or decrease or there will be no effect on equity. So we are done with the third question as well. I'll see you in the next one with question number 4.